Now, wait a minute.
Well, good afternoon, everybody. This is Mike, your host of Insider Secrets. And you know, we're brought to you by My Core Intentions. So let me ask you, have you been thinking lately about your why and about your intentions and what you're trying to create for your life? You know, at My Core Intentions, that's our objective, is to sit with you and help you discover that why, to help you set personal growth goals, business growth goals, and help you achieve them on a daily and a weekly basis. So I really would like to hear from you as to what you're doing daily and weekly to build that out for yourselves. So give us a call, shoot us an email. Let me take today and introduce you to our guest. We're going to come today with a little bit different twist than our normal multifamily sector or property management show. But as always committed, we want to bring you productive content from one of our service providers. So I'm joined today by my friend and Chief Investment Strategist, Chris O'Connor from Minneapolis, Minnesota. Chris, he was a franchise owner at the early age of 21. He started trading commodities in 1982 and went on to be a floor trader. He obtained a Series 7 securities and insurance license after that, then started his own firm, grew it to 5 offices with over 65 representatives working for him. Owned a broker-dealer, registered investment advisor, and was a licensed commodity trader advisor, as well as owned 2 insurance agencies, owned and ran an international hedge fund, and retired at the early age of 2000, or in the year 2008 at an early age. He since has met a lovely woman that he is in business with and came out of retirement to be the marketing director for her firm, Munson Financial. That's an impressive bio. And like I always say, I like to interview people that are a lot smarter than me. So hopefully today we'll get Chris to talk about investment strategy and focus a little bit on market conditions and where he thinks the market's headed. So Chris, good morning. I'd like you to introduce yourself and say hi to our investors, but really I would like you to say one word that best describes you and your investment strategy.
Safety.
Safety.
Yeah.
Wow, that's interesting. Be interesting to hear about that and how you bring that into perspective this morning. So, you know, Chris, you have a very impressive backstory, and we've known each other for a number of years. And like I said, I always enjoy talking to you, and I always enjoy talking to people who are smarter than me. So, why don't we start and let our listeners know how you got involved in the securities business, the investment business, and what attracts you to it so much as you are attracted to it?
Sure. Thanks, Mike, for having me. I really appreciate it. You know, one of the things that I learned when I had my franchise business, which was an auto parts franchise in the late 70s and early 80s, is that even though it was a good business, I got tired of smelly guys coming in and dropping greasy starters on the counter, and I knew there was something better for me. Plus that, if you think about the retail business, especially now with coronavirus going on, you were out of business basically. But more than that is I had a problem with employee theft. And if you've ever owned a business where you have inventory, you know that shrinkage can be a big deal. And back in I think it was about 86, when my first child was born, Kelly, I had a guy steal about $45,000 worth of stuff from me. And I didn't know it. Of course, that was before the CCTV cameras and all that type of security. So it really put a dent in it. And at that point, I thought, you know what? I've been trading for so long. I bought my first mutual fund in 1974. So I'm going to do something different. I'm going to start trading commodities full time. And so I did. And I sold my franchise for profit, which was lucky because of all the shrinkage. Anyway, went forward and got my securities license, my insurance license, and also my real estate license. I was a real estate broker, which I forgot to tell you, I think. And we never really talked about it. How odd, being in the real estate business. But anyway.
Yeah.
So throughout the years, I've always seen the bad things happen, like the crash of 87, the tech bubble of 2000, 2008, 2009, which affected just about everybody. And recently the coronavirus crash. So the thing that's most important to me is making sure that you have your assets covered in such a manner that you don't take disastrous losses. Because Mike, as you know, if you have $100,000 invested and you take a 50% loss, now you've got $50,000. What percentage do you have to make just to get back to even?
Yeah.
Well, of course, you have to make 100%, right?
Right. Where's the safety?
So a lot of people don't realize that, and they say, well, it'll come back. Well, Mike, as you and I both know, we're not getting any younger. So we don't have the time to do that. You know, we're in our 60s already. So it's time to make sure that your money's safe and do the things that we can do to prevent any catastrophic, or easy for me to say, bad things happen, right?
Hey, what's interesting is you talk about being in that auto parts business, which, really, one of the things that I learned early on is if you're going to go into business for yourself, go into a business where somebody's going to always need something like food, shelter, clothing, something of that nature, right? And the auto parts business is always a business people are going to need something in. But what I find interesting is you went from the auto parts business into the financial sector. And were you trading or doing anything in that financial sector while you were in that auto parts business to get you ready to make that switch?
Right. Actually, like I said, I bought my first mutual fund in 1974 as a kid and have dabbled in it since. And I remember as a kid, we also, I think it was like 6th or 7th grade, took a field trip to the Minneapolis Grain Exchange and stood in the balcony and watched them trade, which was really fascinating to me. And as I was going through that soul searching of, what's my why and what's my quality of life, because I was working, 12, 14 hours a day in the retail environment, I thought, what can I do that I don't have to go back to school to get my PhD or my master's? What can I do that doesn't take a ton of money? And what can give me good rates of return and a good income? And so that's why the securities business came up, also the real estate business. So, but I found that I liked working Monday through Friday, and not working on the weekends or evenings because I had a family. And so that's why I let my real estate license lapse.
Interesting. So, one of the other things that you mentioned was about the crash of 2008, 2009. And, we're both old enough to remember 1991, right? And when we came out of the end of the 80s and that crash, I remember getting into real estate about that time. And the first office I worked in, a guy said to me, he goes, you should have been here 6 months ago because properties were selling so fast that while they were putting a sign up and the sign was still vibrating, houses were selling. And that was coming out of that crash and that downturn. And then again in the early 2000s, we went into it, or 2008, 2009. Chris, where do you think we're at today with the result of some of the things that have happened, to this with the coronavirus? And, are we headed for another one of those recessions?
Well, I think the coronavirus, even though it's been horrible, I think it's going to be fairly short-lived. They say there's supposed to be a vaccination coming out within a year. So I don't know if that's, it's not going to be like the Spanish flu pandemic that happened in, 1918, 1919. But the biggest problem that I see right now is our government. And here's why. If you think about our government and its spending, do you know the last time there was a federal surplus? Which is strange to hear because last year, it was the first year we ever had $1 trillion deficit. And so the last surplus we had was in the Clinton administration. Anyway, but I digress. The point is that we have, before the coronavirus, we had a $23 trillion federal deficit. Now, that might not mean a lot to people, but let's say you have a piece of real estate and you have $23 trillion of debt on it, and you're servicing it as you go, but you're only paying the interest. So it's like an interest-only mortgage or contract.
Right.
So that doesn't touch your principal, right? Well, now you add on another $3 or $4 trillion, so now we're up around $27 trillion. And the Congressional Budget Office says that by the year 2030, that we'll have 98% of our GDP in the form of federal debt. So what does that mean? Well, it means that at some point in the near future, in the next 10 to 15 years, we won't be able to pay the interest on our federal debt. So there's only two things that can happen. One, they can cut spending. Well, let's think about that. If you want to get elected as a congressperson, what do? You pander to everybody's needs for money, right? Or if you decide that you want to cut spending, you say, well, we're going to cut Social Security and Medicare, and that's not going to go well. So the only other thing to do is raise taxes. So in my estimation, what we're looking at in the near future is taxes going up. Now, remember President Trump in 2017 had a tax cut, which was great for everybody, right? Especially corporations. The problem is that it's exacerbating the issue of our federal debt. And that tax reduction goes to the year 2026. And if Congress doesn't pass an extension of that, we go back to our old rates. And as we know, 39.6% was the highest federal tax rate. Now, when we get to the point where we're getting close to not being able to pay our federal debt, I'm concerned that things like when you pass on your estate to your kids, there will be no step up in basis, that they'll eliminate or greatly increase the capital gains tax rate, which is not good for any investor. And of course, I think they'll increase regular income rates. So overall, I don't see any good things coming out of it.
So we go back to the one word that you said, right, which is safety. And I say, well, where is some of the safety in that? But if you're a real estate investor today, how are you affected as a result of, these tax cuts and the tax law that got passed in 17 and what's going to happen between now and 26?
Right, and it really takes some planning, because if you look at the different iterations, if you run some different iterations and say, what ultimately do I want to have happen with my money? That's really a generational question. And that's one of the things that's important to me, because I came from a family who started a Fortune 20, top 20 company. And I've seen tremendous amount of wealth go away through the generations. And so it does take some planning. And that's one of the things that I really like to do, is the planning. And so let me give you an example. How do you keep your money safe? Well, first of all, if you have real estate, I don't know if you know this, Mike, but you can hedge your portfolio with options. Now, that's a very deep subject, which would take a whole nother show to do, but there's a Dow Jones real estate futures contract, which if what happened in 2008 and 2009, if you would have had that contract, which didn't exist then, you could have protected any downside in your investments from happening. So it goes like this. Market goes down, the option goes up. So it's kind of a break even. It's almost like insurance on the value of your properties. That's just one way to do it.
Do you have to know how to trade options in order to be involved in something like that?
Well, there's two things you can always do. You can teach yourself, or you can let somebody do it.
Okay.
Again, that's a whole nother show, which, because if you hand it over to somebody and say, here you go, I have no idea what you're doing, that's not a good thing either. I mean, it's just like real estate investing. You can either go out and do the work yourself and reap all the profits, or you can go to a REIT, buy a REIT, and then not have to do it. So you either have a hands-on experience or a hands-off experience. Either way is fine, but you have to be informed. So to answer your question, no, you don't have to know what options are, but at least you should know the basics, so you know what your advisor is doing for you.
Right. And those hands-on, hands-off experiences, sometimes referred to as active or passive investments, both have their advantages and their disadvantages.
Yep.
And depending on who you are as an investor and what you're trying to accomplish and your end goals and the results, one of the things you talked about is generational wealth, right? Mm-hmm. One thing I always try to teach is create short-term cash flow and long-term wealth. And how do we get there? And what's going to create safety and be most impactful for you. Chris, let me ask you this. What is one of the biggest shaping moments, or has been one of the biggest shaping moments in your career?
Well, I think probably the fact that my dad lost a lot of wealth by being managed by a very large trust company. I won't name names, but long story short, unbeknownst to me, he was leveraging his portfolio, stock portfolio, and which I didn't know about. And he kept taking loans against it. And when the crash of 08, 09 came along, it wiped out his $3 million portfolio. So, because there was a margin call. And so that really tells you the good and the bad of leverage. Leverage can be a great thing if it's used properly, but it can be a horrible thing if you abuse it. So again, relating it to real estate, what's your loan to value? How much are you taking? You know, are you comfortable if the value goes down? You know, because there's been companies you could buy cash and then you don't have to worry about it.
Well, what about diversification? So you bring up something very interesting, right? Your dad was really leveraged in the stock market, and that's where he had all his assets, right?
Right.
I for years was diverse, or not diversified, but really leveraged in the real estate business. How do you feel about diversification? And you know, should you have things in both places or not?
Well, it really depends on what your feeling is. Some people are very comfortable having cash flow come from their properties. Some people aren't. So, you know, some people say real estate's the devil. Some people say stocks are the devil. Some people say bonds are the devil. You know, so it's whatever you're comfortable with. But you have to realize that if you have all your money in one project, it could be feast or famine. And so you have to realize that. So, you know, instead of doing one large project, you might diversify out over, you know, 6 or 8 and do it in different geographic locations if you're just doing real estate. Yeah. It doesn't make sense to take the cash that's coming off. If you're getting cash from your real estate, it's wise to reinvest that into some other kind of asset class that has some safety. So that's one of the things that I do, you know, real well, to make sure that, you know, you don't have any downside, but you only have upside.
Yeah, good. Well, that's the benefit of working with someone like you and your firm, right?
Yep.
So talk about interest rates, where they're at today, and where you know, your estimation of where you think they're going to be 12 months, 24 months, 36 months from now.
Well, I think, you know, given what I've said about the federal debt, I can't see the government and the Fed's raising interest rates much because they have to pay. When they raise the interest rates, the rates on new treasuries go up. So it's really a self-inflicted pain, and they have to keep interest rates low because they know for every, you know, 25 basis points they go up, it's going to cost the government that much more. So I don't see, even in the next 10 years, interest rates going up much.
So Chris, what was the difference between today's environment and the environment in, you know, 15 years ago when interest rates were at, you know, where you could get a home loan for, and you were paying a 7% interest rate, right?
Mm-hmm. Well, again, it's just a function of, you know, political system, I believe, because in order to get elected, you want to have a good, you know, and that's a difference between Democrats and Republicans, not to get into some political argument, but to me, and I'm very apolitical, I should say, but to me, the way I've seen it over the years is that when you have Democratic leadership, it's more centric for the human services and more tends to be more towards a socialist side. When the Republicans take power, it tends to be more centered on the capitalistic side. So, but that's just my opinion, you know. If you don't like it, well, I could be wrong, but it would be a first time for everything, right?
Everybody's got opinions, right? But I ask because, you know, you do know a lot. So Chris, let's talk about different types of investment entities and vehicles, you know, things like 401ks and 403s, 457s, you know, let's talk about those types of entities for investing, and, you know, whether you're doing stock market investing or whether you're doing alternative investing in real estate or another asset class.
Yeah, that's really interesting because, you know, given the fact that I believe that tax rates are going to go up, the question I would ask any client is, do you believe that tax rates are going to go up? And if I do a workshop and I have 100 people in a workshop and I ask that question, just about every single person raises their hand that taxes will go up. Then the next question I ask is, Do any of you have a 401k, a 403b, a 457 deferred comp plan, any type of qualified investment, IRA, SEP, HEO? And about 100% of them raised their hand. And I said, well, let me ask you this. If you're going to buy a property or a stock or whatever that investment is, and you're going to take a loan for it, and they said, yeah, we'll give you a tax deduction for it. But the loan interest is determined at the end when you decide to sell it or pull the money out. Would you do it? Well, obviously the answer is no. But that's exactly what you're doing when you have any kind of qualified plan like the 401k, 403b, IRA, because you're going to pay 100% taxes on that money when you draw it out at whatever tax rate the government decides it's going to be. So if we look at the scenario we just talked about, if rates go up to 30, 40% or more, those are the rates you're going to have to pay when you pull the money out. Now, let me ask you a question, Mike. I don't know, I'm putting you on the spot here a little bit. Do you know what the highest tax rate in the United States was?
I remember numbers like 18, 21%, but I think that was back in the early 80s.
No, highest, not lowest.
Oh.
Well, let me tell you, it's 94%.
Oh, tax rate. I'm sorry. I was thinking
Tax
interest rate. Okay.
Oh, no, tax rate.
Yeah. I'm sorry. That's my fault.
No, that's okay. Well, it happens to be the highest prime rate was 21.5% in 1981.
Right. That's what I was thinking
1880,
about. Right.
but it was high. Because
you're talking about tax rate at 94%.
94% tax rate. Isn't that crazy? Of course, that was after World War II. And, you know, what happened was government spending was wild because of the war, right? So they cut spending because they didn't have a war to support. However, a lot of people don't realize that tax rates were as high as 70%, even into the 60s and 70s. So it's not uncommon that those rates could reappear. Now, anecdotal story, Ronald Reagan during the war years, you know, when he was an actor, he made 2 films a year. He got paid $100,000 because if he made over $200,000, the federal government would take 94% and California would take 6%. So literally he could not make any money if he made more than 2 films a year. So he'd make 2 films, take the rest of the year off, start filming again in January. That's crazy.
It is crazy. So what do you feel is the greatest risk to building wealth and having a good quality of life today, Chris?
Well, I think good quality of life is the start of where you should think about building your wealth, because that's really the goal. Because some people don't realize, I shouldn't say a lot, but some people don't realize that money is just a tool to do the things that are important to you. So part of my job as an advisor or working in the investment advisory business in the past is to find out what are the things that are important to you. Do you have a family? Do you have kids? Do you want to give back to your charities? Do you want to travel the world? Do you want to buy a Winnebago and drive around the country? What is it that really gives you pleasure? You know, I try to play that guitar back there. It gives me pleasure when I do it right, but that's only about 5% of the time. So,
playing or doing it right.
Sausage fingers don't work too well. So, but that's the whole point. I like it, you know, and that's one of the things I want to do. And the other thing is I really like this business. You know, I retired and I decided to get back into it because it's not about the money, it's about helping people. And I think when you look at what you're trying to do with your life, find out what your why is, find out what your real motivation is, and do something that you really have passion for. Because if you're stuck in a job and you hate it, it doesn't make any sense.
Right. That's one of the things in my coaching program I talk to people a lot about is living a balanced lifestyle. And how do we help you? Because one thing I know for sure in the real estate investment world, whether you're buying property, whether you're on the management side, you live a pretty intense on demand to other people's answer. You're needing to answer to other people quite often. It can become pretty demanding. So trying to live a balanced lifestyle is something that we really try to deliver as a end result for our clients. I want to back up for a minute, and I want you to talk about two things, if you would. When we go back and we start talking about 401ks and 403bs, talk about self-directed IRAs and how that vehicle helps or is more beneficial for a real estate investor. And I also want you to talk about the ability to have a tax-free retirement.
Sure. Well, that's a good idea, because if you actually take an IRA and a vehicle like a Roth IRA, and because the IRA, you get the tax deduction, the Roth, you have to pay the tax. And people say, well, I'll have more money in my regular IRA because I didn't pay the tax than I would in my Roth. Well, that's not necessarily true, because you have to pay tax in the future and you don't know what those rates are going to be. So the question becomes, can you take your property or can you buy a property in a self-directed Roth IRA or even a Roth 401k? Now, a lot of people don't realize that you can use independent custodians to do a Roth 401k. And if you're over 50, you can put $26,000 away per year. You know, you go 4 years, that's $100,000. You leverage that, and you know, it becomes pretty substantial. And so there's some things you have to do properly to make sure that, you know, if you're going to have leverage, because sometimes it's called UBTI, unrelated business taxable income, that negates the tax-free status. But, you know, there's definitely ways that you can have a tax-free retirement from cash flow that's coming out of your property. And if you aren't doing that now, you should be.
So that's a pretty interesting idea of thinking, man, I could go into retirement, call it $500,000, $1 million, and have it tax-free. Mm-hmm. So it'd be a pretty, you know, again, we're back to that word safety, right? Now we've created safety, plus we've created a lifestyle that, you know, isn't going to get decimated moving forward. Let me just ask a quick clarification question. If somebody was starting a new job today and they had the ability to do a 401k, or they were working in a job and that job offered a 401k, can you elect to do a Roth 401k at that period?
It depends on what the employer wants to do. So my advice would be, if you are offered a 401k with a match, take at least up to the match. You know, it's free money. Doesn't make any sense. And then with the rest of it, you can either do a regular Roth IRA, or if you can talk the employer in, if it's small enough, to do a Roth 401k, you're so much better off.
Yep.
One of the things that you have to look for is, when you're doing your retirement planning, is, you know, keeping your adjusted gross income and your provisional income low enough so your Social Security is not going to be taxed also. And having tax-free income out of a Roth, that doesn't count as provisional income. So that can save you money too. So there's a lot of different things you can do for tax abatement.
So a lot of our listeners on this show are younger. They're not our age, Chris. You know, you've already dated us. But what I'd like to know is Social Security going to be there for them when they get to be our age? 20 years.
Well, I tell my kids, yeah, I have 4 kids from 33 to 22. Yeah. And I tell them, don't count on Social Security, because it's probably not going to be there.
Yeah.
And because if you look at the unfunded liabilities that Social Security and Medicare have, it's astronomical, especially with the inflation going on in healthcare costs. So when we turn 65, Mike, we'll have Medicare, but I really don't believe that's going to be around. And we can do the doom and gloom about what's going to happen with, you know, the value of the dollar when the government, you know, starts raising taxes and you know, or if they default on their debt. And, you know, the government has to do something. And there's just no way around it. What they're going to do is the question, but I would probably think that they're going to raise taxes. So that's why tax-free investing, to me, makes so much more sense, because you can completely eliminate the risk of taxes going up in the future. And that's the safety component.
Yeah. Interesting. So Chris, here we are sitting in the end, what appears to be the end, maybe the middle. They say it's going to start again, this COVID-19 epidemic pandemic that we've been experiencing for the last few months. How has this changed the rules of the game and the investment game, the savings game, and where do you see us in a year from now?
Well, I think things are going to be pretty back to normal. You know, if you think about it from the standpoint of somebody having real estate, whether they're commercial or retail or whatever, you know, I certainly wouldn't want to be in the retail space right now. But I do believe that, I mean, if you think about, you know, the companies that have done well, like the Instacarts and the Amazons and, you know, the Zoom, you know, like we're on right now, those type of technologies will do really well. As far as the real estate goes, because population is expanding, I still think you're going to do very well in multi-unit properties and even single family homes. Here in Minneapolis, actually, Darlene and I just bought a house, or just in the process of buying a new house, and the market is crazy here. I mean, I look on realtor.com and instantly, if there's 10 listings, 8 of them are pending. So the market is crazy hot here. And so I think in the year's time, you'll probably see that supply coming up more because of some foreclosures. But beyond that, I think things are going to pretty well continue the way they have been. Yeah. Good opportunity no matter what.
Yeah, I think, you know what, here's one thing, and I know you'll agree with this, is there's always a good buying opportunity. It doesn't matter if you're in an up market or a down market, you're going to make money. You know, it's like the old cliche that the only thing different between today and 20 years ago was they got started 20 years ago, but you could get started today because you still got 20 years in front of you, you know? So, and
well, I hope I have 20 years in front of me.
You better. So speaking of that, what's the next step for you? Next 3-5 years?
I think we're just going to work probably another 5 years. And then, you know, we're considering moving to Puerto Rico because Puerto Rico has no taxes, or a 4% corporate tax, no personal tax. So as an example, if you're going to make $200,000 a year and you're going to pay here in the States, you know, 30% tax, well, that's a $60,000 savings. Now, I don't know about you, but I'd rather put it in my pocket than Uncle Sam's pocket.
Yeah. So aren't there places in the United States, though, that you don't pay some personal income tax?
Yeah, Puerto Rico and the Virgin Islands.
There's state tax, though, that's not paid in a few states, too, right?
Oh, yeah. But the biggest tax is the federal tax, no matter what.
Federal tax, right.
New Hampshire, Las Vegas, or Nevada. I had a corporation that was based in Nevada, but we didn't pay, you know, state tax on that. But I'd rather avoid the big tax than the little tax, or all taxes, as it comes down to that.
Okay. All right. Good. So what advice would you give a new real estate investor today? So somebody who was brand new going into the business, what advice would you give them?
Always start with the end in mind. Yeah. Because if you have no plan for the end, or how you're going to transition out of that property, the beginning doesn't make sense. And it doesn't matter what investment it is. It doesn't matter when you get in, or, you know, everybody's thinking about what's the best. I mean, it does matter that you get a good deal in real estate, but in stocks, you know, it's the exit that's the most important, no matter what.
So, you know, it's interesting, and this is my segue in. Thank you very much. The last several shows that I've done, somebody has brought this topic up, the end in mind. You know, Stephen Covey, in his book, 7 Habits of Highly Effective People, wrote about that. That was the first chapter in the book. Start with the end in mind. Mm-hmm. I have spent, and I talk about this a lot, but I've spent hundreds of thousands of dollars on training and seminars and personal coaching programs around real estate, in the real estate business, to be left empty, where people don't talk about the end. And, you know, there's the old cliche in real estate, right, that says you make money when you buy your real estate. But the problem is you don't realize it till you get out. That's when you grab the gain, right? That's when you physically take possession of the money. You might make the money up front. So nobody ever teaches that. Nobody teaches planning. So I have a book coming out this fall called Exit Plan. And I talk about this exact subject in this book. And we talk about how you should plan when you're going into a deal before you ever even close it. I've sat in coffee shops with a cocktail napkin and written on the back of them, just listed out what the end looked like. How long was I going to hold that deal? How much profit did I want to see? What the occupancy needed to do. And when you get clear on the end, it brings safety into it. And I think it makes a lot of things happen easier for you. Your execution becomes different when you have that pre-planned like that.
Mm-hmm. Yeah, and if you have a property that you're thinking about moving, or rolling over, you can build wealth by doing 1031 exchanges too, which a lot of people aren't really aware of, but that's a whole nother podcast.
That's another show again, right?
Yeah.
So now we're going to have you back a couple of times, it sounds like, for a couple of shows. Chris, I want to thank you for being here today, for your knowledge and your experience and how you've brought that forth. And I'm sure that a lot of people have learned a lot of things. If, as the last couple of comments, anything that you would want to say to a new investor or a seasoned investor that you maybe haven't already said?
Oh, there's a lot. So don't open that door for me. Otherwise I won't shut up. But no, not really. I mean, if you do have questions, you can reach me at chris@munsonfinancial.com. That's MUNSON financial.com, CHRIS, chris@munsonfinancial.com. And if you have any question at all, I'd be happy to answer. No obligations.
And Chris, I want to thank you again for being here today. You've always been a great friend, and we're going to have your information on our website. And if anybody has any questions, they can reach Chris or they can reach us at My Core Intentions. And I will look forward to seeing each of you next week. Thanks and have a great day.